This is High Money, where you learn how to make, to invest, and to grow money.
There has been several debates about the widening gap between the rich and the poor, the gap between CEOs and workers. And one of the reasons for this gap is that workers are being paid wages, just wages or salary, while the CEOs get some of their wages in stocks, in stock options. So over time, what happened is that the stock market would have done its work, increasing the cumulative interest would have impact on the income of the CEOs, widening the gap over time, despite the fact that CEOs are also paid several percentage higher than than ordinary workers. So this is increasing the gap between the workers and the CEOs. So I want to draw your attention to this so that you can also benefit from the stock market by creating a plan for yourself and for your family. So there has been a trend lately showing several people that have retired from work, from active service, right, coming back to work because of high cost of living, right? They're unable to meet their daily expenses because rent is going up, the cost of so many things are also going up. So they are all coming back to work, and some people are working at a very old age. Now let's listen to. I saw a video online. I decided to show you some of what is happening. So let's listen to this video and see the complaint by this elderly man working at over 70 something years old.
So using your common sense, would you say that 14 hours of work every day is excessive?
It is, because I have an 18-hour day. I have 12 hours in my work. I try to come home and maintain my home with a diabetic person. I have an 18-hour day. I don't take my shoes off for 18 hours. I'm 78 years old, still working, because I lost practically everything I had in 2008 with the bank collapse. And so I had a business. I had to go. I got a job at 60 years of age. I had to go back to work.
So, what we are trying to do now is to teach people some of the opportunity in the stock market, so you won't be in this shoe. You don't want to get to 80, 70 years old and still be working, or even 65 years old and still be working. So, I want to show you a model used by rich people on how they structure their life. Now let's look at this first model. So what happened is that the rich earn money. These are some of the model that that the rich people understand. They earn money, right? Now they put the money in the stock market. Then they fund their life using proceed from the stock market. The proceed might be dividend. Some company pay regular dividend, right? And there are also other investment options like real estate. They earn money, pass it through the real estate. You understand? Maybe they invest in commercial building, invest in residential building, invest in several other kind of models in the real estate. Then use the proceed from that to fund their life. And some create businesses. They build businesses and use the proceed from the businesses to fund their life. But the average people are not getting how the capitalist economy work. So they just earn money and use it to fund their life, pay bills, and this creates what we call a rat race. So you create what we call the rat race, and over time, this person become poor, right? So that over time, the stock market always grows. So if you have an investment in the stock market, apart from the fact that you are going to have dividends from some dividend paying stocks, you are still going to have capital gain, right? So the capital gain is that your investment, if your investment grows over time, if you have like say $1,000 investment, the investment will grow at an average about 7% or 8% per year. Over time, it grows from maybe from 1,000 and up to 2,000, 3,000, or depending on the numbers of years that you invest the money. So instead of having a lot of savings in the bank or stock at home or acquiring some lavish lifestyle, so it's good to put some of those excesses in the stock market so that it can the cumulative this thing can work for you. Numbers of adults, the percent of adults that invest in the stock market are actually very small compared to the population, right? And it's even worse in some developing countries. So you now understand why we're having a wide gap between the rich and the poor and in some developing countries. You say this is in the United States, we have about 58% of people investing in the stock market. In Hong Kong, 57, and it goes down. And when you begin to come into the developing country, like you see Argentina just 5%, India 3%. A lot of people are not taking advantage of the opportunity that we have in the stock market in some of these countries, right? So that's one of the challenges. What exactly is the stock market, right? So basically, the stock market is where you buy and sell the ownership of a company. So when somebody start a company and the person grow it up to a point and decide to raise some capital from the public, so the person get listed on the stock market. So now in this market, you can now lend your money to companies and get a percentage of that company, right? So what happens is that when that company make profit, you get a percentage of the profit depending on how much you've invested in the company, right? So this is known as stock or equity. So the stock market is a marketplace where buyers and sellers come together to buy and sell ownership shares of publicly traded company. They have different names in the US. We call them. We have the New York Stock Exchange, and we have the Nasdaq. In Nigeria, we have the Nigeria Stock Exchange. In UK, you have the London Stock Exchange, right? So now, who are the players in the stock market? So we have individual can invest in the stock market, institution, banks, hedge fund, pension fund, insurance companies, sovereign wealth fund as well. They all invest in the stock market, taking advantage of some of the opportunities in the stock market. So an individual can buy stock through a brokerage account. So a brokerage account is just like your normal bank account, right? But this is not with banks, but it's with stockbrokers. So you go to a stockbroker, you open an account, then the stockbroker give you an access to invest in stock, right? So when you go to the bank, you open an account, and the bank give you an access to save your money in the bank, right? And also to do some short-term investments like certificate of deposit, the one we call fixed deposit, right? But if you want to access the stock market, you need a brokerage account through a stockbroker, right? So the stockbroker is like the middleman between you and the stock market. So then we have mutual fund. So mutual fund is an institution that come up to get fund from several people. They accumulate all this fund from several people and then invest this fund in the stock market. So the proceed that you get will depend on the amount that you invested in mutual fund, right? Then we have hedge fund. So hedge fund take more risky options, investing in something more risky, but we have a higher return. So pension fund also invest some of the pension that workers paid are actually invested in the stock market, right? So pension fund gets a fee for helping workers to invest their money in the stock market. Insurance company as well also invest in the stock market. Then government also invest in the stock market through sovereign wealth fund. So some of the institutions in the stock market now, right? We have the stock exchange where people transact ownership of companies and securities investment, different kind of investment are called securities. So shares, options, future, time deposits, short-term investment, all kind of investment are called securities. So then brokers, they are the intermediary, they come between you and the stock market. So we have the market makers, we have investment advisors, we also have the regulatory bodies. In Nigeria, we have the SEC, Security Exchange Commission, and also we have the CSCS and several other bodies that regulate the stock market. Then we have the clearinghouse, and the custodian house also are the one that help you secure your stock. They sort out who owns what, right, and ensure that the ownership is not mixed together. So we have the underwriters. These are the people that help companies to raise fund from the stock market, right? So when a company wants to raise fund, it goes through an underwriter that help them list this stock in the stock market. Then we have the issuer as well. So let's look at the basic of stock trading and execution. Stock, like I said, is where a company needs to raise capital, issue a stock, selling a percentage of itself to the public. So the price of stock is determined by several factors like demand and supply. So when a lot of people want to buy stocks, right, the price goes up. When a lot of people don't like the stock, right, the price falls. So a lot of factors drive stock. One time I would like to explain. So we have this market order. So we know what the stock price is, right? So now we have this market order. So market order is a request to buy or sell a stock immediately at the best available price. So that means the price of the stock fluctuates over time, right? So when you go into the market and just buy at the recent price, the current price, so that's the market order. So that means you are going to get the stock instantly, but you can't determine the price that you are going to buy the stock, because at the price where you execute that trade becomes the price that you have to pay, right? So if I go into the stock market now and I just to buy, let's say, Facebook shares, I can't determine the price I will buy it, but I'm very certain that I'll get the shares, right? So it can be maybe 300, maybe 150, depending on the fluctuation, depending on the point the stock price is when you bought it, right? Now, the limit order is the second alternative here. So what happened here is that you want to buy it at a specific amount. So you fixed the amount you want to buy the stock, and say, okay, I want to buy it at $100 for 1 unit. So what happened is that you have to wait till the stock fluctuates and get to $100. So that means you can't determine when you buy the stock, but you can determine your price, right? So it's more like the opposite of each other. Now, let's look at market performance. We have the bull market, we have the bear market. Bull markets occur when prices are generally rising. In a bull market, there's optimism, economy is doing fine, investors are, they are buying more of the stocks over maybe around 3 months. So when the stock market increase consistently about 3 months, around 20% accumulatively, we say the stock market is in a bull market, right? But the opposite is the bear market. When the stock falls consistently over time, we say the stock is in a bear market. Now, what can you get from the stock? What are the returns you can get from the market? You can get the dividend, you can get capital gain, right? So, not all companies pay dividends, but some companies pay a portion of their earning in form of dividends. They typically pay about every quarter or every year, right? So a dividend is like a portion, maybe around 6% of what you invested, or 2% of what you invested in the stock market, right? Maybe every year, but some company pay twice a year. Some company pays 4 times in a year. Some company pays just once in a year. So another thing I get from the stock market is the capital gain. So capital gain might be maybe you invested $100 and due to good performance in the stock market, the $100 has increased to maybe 120, or so the capital gain here is 20. Then another thing you can also get from the stock market might be you can get some excess stock, and the stock can decide to give you additional stock. Maybe if you've bought about 1,000 units, and maybe the stock make a lot of profit over the year and decide to give you, for every 500 stock, you get 10 or 20. So if you have 1,000 units, so you get 40 extra stock, right? So that increase the number of shares that you have in that company. Although it might increase the value, it might reduce the value and still amount to the same thing. But over time, you get dividend on the number of stock that you have, or you get capital gain on the number of stock that you have. Now, another concept I want to explain is the risk and return. So, like I said at the start, we have several kind of investment options that you can explore. So we have time deposit, we have treasury bill, we have saving, or the fixed investment, we have government bond, corporate bond, preferred stock, mutual fund, common stock, real estate, options, and futures. So I won't go into deep explanation of this, but currently I just want to show you that the risk involved in the investment and the expected return in each of these investments varies. So depending on the investment, so the most risky investment here is the future investment, and the less risky is the treasury bill, right? So the higher the risk, the higher the returns. The lower the risk, the lower the returns. So the risk is the possibility of losing money when you invest in the stock market. So returns measure the profitability of an investment by comparing the gain and the loss, right? So then we have several kind of risk. We have the market risk, we have the credit risk, we have inflation risk, we have liquidity risk. So the risk, market risk, is that the value of the investment might fall due to macroeconomic issue. Credit risk might be that maybe the company that you bought stock with collapse and are unable to pay you anything and you lost all your money. And another risk might be inflation. But over time, stock have seen to perform slightly well during inflation compared to cash, compared to savings, or compared to fixed deposits, where your returns are fixed. So when there's inflation, you lose money, right? And another thing is the liquidity risk. So for the liquidity risk, it says that you might not be able to sell some stock as early as possible, right? Because they are not liquid, they are illiquid, so you might not be able to sell them. Some stock are hot cake. If you want to sell it now, you get buyer immediately. So the same thing, some investments like real estate. Some real estate might be very illiquid. They are not liquid, right? So imagine if you need more, you need some fund in time. You might want to sell this investment so as to quickly meet some need. You might not even get buyer in 3 or 6 months or in a year, right? So that's why it's good, to diversify your investments, to have some investments in treasury bill, to have some in savings and fixed deposits, to have some in real estate, to have some in stock, right? So and to have some cash for emergency period, right? So that is what our liquidity is talking about. Is liquidity helps us to achieve. It helps you to to achieve when you need the fund instantly. How liquid is the investment? How liquid is your stock? Can it be sold instantly? So that's why you see company that they have good brands, like say Facebook, Amazon, right? They are easy to sell, and at times what determine whether a stock is liquid or not might be the price. If the price is very high, maybe for some stock might be like $200,000 for 1 unit. So that stock will not be very liquid. You understand? So that's about liquidity. Now let's go to how to pick the best stock. The first thing that you need to do to pick which stock you like to invest on is to define your investment goals. That is, what's your risk tolerance? Do you want to invest in a growth stock which is very volatile, right? Or a stable stock, right, which is less volatile? Or do you want to invest for short term, or you want to invest for long term? So just at by the side, if you want to, investing in the short term, is called trading, right? If you just investing for capital gain, you buy it, you buy the stock when its price is low, you sell when it's high, right? That's trading. You are trading. So our aim in this presentation is to encourage long-term investments, to create financial freedom, right? So short-term investment is more risky in terms of, you are buying with the expectation that the stock will rise, right? So, but long-term investment elsewhere are also risky, but over time, the stock do recover if you are in for a long time. So another thing you want to look at is what kind of income do you want to earn from this stock? Do you want to earn dividends, or you want to earn capital gain, right? So if you look at capital gain, you invest and wait for some certain period, waiting for the stock to rise. Or dividends, you just keep buying and hoping that the company will pay you dividends continuously every year, right? And use that dividend to fund your lifestyle. So the next step is to identify industry that are growing and they are likely to benefit from the current economic conditions. So you look for a trend and see which industry is working fine. Now, currently, there's a lot of excitement about artificial intelligence, and there are some old industry as well, like the oil sector. The new sector we have now is artificial intelligence, and we see a lot of growth. If we've seen a lot of growth in that industry, and some people have made fortunes from the industry. So then you then go further to see the company financials. Is revenue growing? Is the company profitable? What is the earning per share? So the profitability ratios to assess how efficient a company is generating profit. You can also look at the earning per share. This tells you the company ability to increase profit per each of the share. For each share that the company sold, what is the profit that the company is making? Also, you can analyze the company model. Is the company competitive? Does it have a good brand? Does it have any patents? How about the management? Are they experienced in running businesses? Because the quality of the management determines the success and how long the company is going to stay in the market, right? So you can also look at several news analysis reports and see what professionals, not just people, not just on social media, what professionals think about this stock. But it's good to do your own personal analysis and be sure. And some of these analysis as well are available on some stockbroker websites. So the analysis has been done. You just have to look at some of these financials and ratios to make your investment decision. So we also have ways to examine stock. We have technical analysis, we have fundamental analysis. So our technical analysis look at charts, fundamental analysis look at those financial that I shared with you. So how do you manage risk? The stock market is risky. You can lose investment. Manage this. You can decide to diversify. When you buy stock, you can say, okay, I'm not just buying MTN stock. I also want to buy Airtel. I want to buy GT Bank, I want to buy Access Bank, I want to buy several other companies' stock, right? So you buy different portions so that if one company does not perform very well, at least the other one will perform very well, right? Another way is to say, I don't want to invest in stock market alone. I also want to invest in real estate. I also want to invest in oil. I also want to invest in businesses. I also want to invest in several other things. So that is called asset allocation. You on diversification, you can decide to invest in other geography, like so. Oh, I will invest a portion of my money in the US stock market, a portion in the UK stock market, a portion in Japan, Indian, China stock market, a portion in Nigeria stock market. You diversify across regions, right? So there are also hedging. You can hedge against your investments. Maybe using future, maybe other derivatives, options. Options. You can buy an investment and say, okay, maybe I buy a stock for $100, for instance, and I say $100. I'm hoping that it will keep increasing, but if it falls, I need to have somebody readily available that can quickly buy it from me. So okay, I'm okay to lose $20. I bought it for $100. I'm okay to lose $20. So if the price falls to $80, I need someone to buy it for me. So you can make an agreement with someone. So once the stock falls to 80, the person now will buy it from you. Maybe because the person wants to hold the stock for a long time. The person is looking at dividends, but you are looking at capital gain, for instance. So if the capital gain does not work out, if the price falls, the person can buy it from you so that you don't continue losing money, right? That's option. So future is an agreement between you and somebody to say, oh, the price of this thing might increase in the future, right? Now let's make an agreement to sell it for me at this particular price, right? Because I know I'm going to need it in the future. So, but I don't know whether the price might increase or not. But let's agree, you are going to sell it for me for $100, right? So in the future, whether the price falls to $80 or the price increase to $150, you have made an agreement with the person, so the person have to sell it for you at that $100, right, in the future. So a lot of companies use this, a lot of manufacturing companies use this, especially for oil, for crude oil, or for raw materials and all of that. So it's also used in the stock markets. There are also several other derivatives you can use, for risk management to protect your stock, from losing your stock. So you can also use dollar cost averaging, where you just continue buying the stock over time. So when the price falls, you buy. When the price rises, you buy. So it is expected that over time it's balanced out. Another risk management option is the stop loss order. So the stop loss order, you just set up the stock on the platform. Now, if the price falls maybe by 10%, sell it. Or if the price falls by 5%, sell it, right? So another might be rebalancing. You align your stock, to a target allocation. You might say, okay, I want 10% of stock in the telecommunication. I want 20% in the banking sector. I want 30% in social media companies, right? But over time, as the market fluctuates, volatility and everything happen, that percentage structure will change. So you now rebalance it, selling off. You might sell off some that have more than 20% and buy the one that falls. So depending on your investment goals, you can also protect your investment by insurance, getting involved in insurance to insure your stock. So there are several options to protect your investment. So there's no need to run away from the stock market. All you need is to accumulate knowledge, learn what's happening in the stock market, learn how to protect your investment, and get the best out of the market.